Welcome to Crescat's live market call featuring our macro and activist mining research. I'm Kevin Smith, Crescat's founder and chief investment officer. Before we get started, please read through our important disclosures being shown on the screen now. These additional disclosures regarding the risks involved in the type of investments we will be discussing can be found on Crescat's YouTube channel and on our website. Crescat's live market call is about sharing timely macro and newsworthy geologic updates on Crescat's activist metals position, both positive and negative news across our holdings as it arises. The discussions and topics will not cover all aspects an investor should consider when deciding whether or not to invest in any of the securities that are part of this presentation. The type of investments that we discuss can carry significant risks, and whether or not to invest should be a determination made with the complete investor's suitability in mind and in connection with a professional advisor. The topics and themes we will discuss are the opinions of Crescat as a mining and exploration industry advocate. Our objective is to share the overall geologic progress of our strategy in creating new economic metal deposits in viable mining jurisdictions around the world. The forward-looking business opportunities we discuss may not come to fruition or may not have a significant impact to the value of the security. These presentations should not under any circumstances be considered investment advice or an offer of investment advice or services. Crescat's managed funds only accept accredited investors, and this presentation has generally been put together with that level of audience sophistication in mind. Any securities discussed do not represent any full portfolio and may only represent a small percentage of any strategy's holdings. These securities may or may not be held in any Crescat managed portfolio. If you enjoy our videos, please click on the like button and make sure you're subscribed to our YouTube channel to get notified of upcoming episodes. You can also follow Crescat Capital on X for ongoing macro research and important news updates on our activist metals positions. If you want to learn more about Crescat's investment strategies, we encourage you to reach out to Merrick. His contact information is on the screen and can also be found on our website at crescat.net. So today, it's just a little bit different format. Quentin has been traveling in Peru. He'll be back next week with us, but Tavi and I thought we would get a little extra macro presentation in today. So Tavi's actually going to go first. He's got to leave in about 20 minutes, and I will do the second half. So take it away, Tavi.
Sounds great. Thank you, Kevin. Yeah, I mean, it's not like there's a shortage of things to talk about after everything that has been happening in the markets recently, but I try to pick a few charts that are relevant to the discussion that were, not only internally, but also markets regarding, positioning and all sorts of things that we think are relevant for this. And in this presentation, we'll start with what I think it's the most important movement happening. There's a lot of emotions in markets right now. You've got gold prices. I was just looking at it. Gold prices from December 20th went up about $340 an ounce. Today, it's dropping $60. Everybody just turned bearish all of a sudden. And it's really interesting how these things change quickly. Silver, same thing. Silver was up 4.5% today, gave everything back essentially from its performance. Now, I happen to believe we're on the verge of a very significant change in prices of most of these securities, and so I'm especially the ones that have been lagging. Miners, miners, silver, and others. We'll talk about this in a minute, but this chart that you're looking at the screen is probably the most important chart right now. The DXY index, the dollar index, had a bad day yesterday. Has been actually constantly having a few bad days in the last few weeks, as you can see on the chart. But now we're retesting actually levels that we only saw back in 2023. Not a lot of people talking about these things. I mean, the dollar clearly is not as weak, as strong as a lot of people thought it is. And it's being perceived as a very strong asset relative to other currencies. And it's not being true at all. And when I factually look at the charts or the performance of the dollar versus different currencies. this to me, it's a very meaningful break, because if you look at the positioning for most investors right now, it remains heavily on the long side. Most investors remain very long the dollar versus other currencies. You speak with most people. I remember this very well. I was in a conference in Switzerland, and I asked a question to the audience. I said, how many of you think that the Canadian dollar is going to outperform the US dollar in the next 12 months? You know how many people raise their hands? Zero. And, those are the things, those are the signs. And you look at the positioning on that as well, the CFTC positioning of how many people are speculating if the dollar is going to go up or down, the Canadian dollar. And everybody is ultra bearish on the Canadian dollar. I'll just give you an example of one pair of currencies, but all sorts of currencies have shown similar level of positioning being offside, of which I think it will actually be, it's sort of timber for something bigger to happen in terms of the, when investors go from one side of the balance to the other side of it. And I do think we're going to see that. Let's go to the next chart. And one thing that has been remarkable is this link between the US dollar and the 10-year yield. So one is in blue, that's the 10-year yield in the US nominal terms. And then the white line is the US dollar. And what is interesting about this chart is, look, in my view, it's, if you look at the constraints from a political standpoint, especially in the US economy, you've got two things that are incredibly difficult, which is, the dollar being very strong. I mean, that basically sucks all the capital from the rest of the world, and could mean also a lot of financial tightening conditions, and of which tend to also have a lot of impact in the U.S. economy. Or on the other side is rising costs of capital, which we all know that's absolutely unsustainable given the fact where the debt is. We're currently paying, interest payments on the debt is approaching 5% now. I mean, we can't be doing this for much longer. The debt is growing exponentially just on the interest payment alone, actually causing that to happen. So if we want to reduce to levels that Scott Besson and others have been saying, that to 3% of deficit, we got to take care of that blue line that you're looking at the screen. And I'm not sure you can take care of that blue line without also causing the white line have an impact as well. I do think it's a much easier play, or a much easier, higher conviction idea to look at the real rates, given the fact that we're seeing mixed signals on inflation, particularly government data coming in very strong on that front. But to me, it seems like we're actually facing a more stagflationary environment. The picture is becoming more and more clear that stagflation is taking place here in the U.S. And I'll develop on this in a minute. Let's go to the next chart. This is just a list of currencies that have been performing well versus the dollar. So you're looking at, the Russian ruble is actually the very first one in that list. The Brazilian real is the second one in that list. It's Colombian peso, Chilean peso, and some others. And then you have on the other side, Argentinian peso, which has been doing really well over the last few years. Finally is giving some back. I don't think it's anything major there, but clearly there has been a lot of, especially I would say, South American currencies doing very well, of which I have spoken many times here in this presentations of our optimism and outlook for that region of the world. I do think that there's a lot more to happen there. It's just the beginning, in my view, and this change of the dollar is also potentially profound, potentially also the beginning of a trend of where capital starts flowing back to those regions that have been neglected for a long time. So let's go to the next chart. On the next chart, we're just stepping back and looking at the history of the US dollar cycles. I've shared this chart before, and I do think it's probably one of the most meaningful charts that at least I worked on personally of the last few years. And my view on this is that we're at the beginning of a downward trend for the US dollar, long-term downward trend, of which could have also an impact on other assets that have been benefiting from this dollar movement, particularly equity markets in the US, particularly the American exceptionalism that has been overly priced in markets already. Look at any company in the US in terms of valuations relative to other parts of the world, and you're going to see that differential being at a historical extreme. I think there's a lot of things that would actually be rebalanced to the other side. This is why I'm also not only focused on natural resources, which tend to do very well in those environments, particularly gold, which I think is leading the way. But also you can see things on the rest of the world in terms of markets that have also lagged the U.S. economy in a substantial way that I think are poised to start doing better. So let's go to the next chart. All right. Well, a weaker dollar can actually have an impact on inflation. A weaker dollar can have an impact on a lot of things, but one of them is inflation expectations actually starting to rise. I mean, I've shown charts of the 10-year break even. Kevin has shown charts of inflation expectations in the past, but nothing better than looking at actually prices of commodities that tend to be linked to those things in the real world. If commodity prices are rising, that's essentially what causes a lot of other things to rise in prices as well. So you're looking at metal prices overall have been on the rise recently, despite the decline today, and or just the fading aspect of some of these of these assets. Copper prices have been actually rising significantly. I mean, it was back in 2020 trading at around 200. It's now trading at around 500. Usually when you tend to see these breakouts, you tend to see something meaningfully higher. And I wouldn't be shocked at all if we see that. And so copper is showing a very different picture, especially regarding the stagflation things I just comment on. But I actually think it's much more reflective of what's happening with the inflationary environment that we're in still in this, even with this administration. Let's go to the next chart. You can also see natural gas prices, of which today have made new 2-year highs in this chart. A little less of that, but very, very interesting. Natural gas prices are highly tied to consumer prices overall. So you want to pay attention to this. And I've said this before as well. Oil is something that has been not showing the same level of optimism, although I personally remain very bullish on oil. And I find it interesting that it is one of the few commodities that have not responded as well as other commodities. And I don't think that's sustainable either. I think we're going to see oil prices also move along with other commodities here. One of them being natural gas in this case, which is highly, highly volatile. But the trend overall since October, November has been clearly in this chart has been moving to the upside. I thought this would have something to do with AI. The natural gas seemed to be the kind of in the sweet spot of timing when it comes to the needs that we have for electricity consumption and all sorts of things. Natural gas may actually be the solution here in the near term for most of these things. A lot of people talk about nuclear, but those things are not going to be ready anytime soon. And so natural gas is your short-term solution for a lot of these electricity consumption gaps that we may see, given the fact of how much we're seeing of developments on the artificial intelligence and onshoring efforts from the Trump administration as well. Let's go to the next chart. Agricultural commodities is a very critical one. I mean, think of the amount of social unrest that we've seen historically because of food prices rising, especially in the Middle East and other places. Well, pay attention to this chart. I mean, agricultural commodities has made another decade highs, essentially. It's pretty close to a decade high in this chart. We're looking at a DBA ETF in this case, of which there's a disclosure there. The Crescat may or may not hold positions on this ETF. But the point of this slide in general is just to show that that tends to have a very strong correlation with food prices, and food prices are likely to be impacted by the chart you're looking at the screen, and that's highly inflationary as well. Let's go to the next chart. This is a chart that looks at the equal weighted commodities index. I put on two things here. One, there is the first wave of inflation that happened in 2021. Arguably. Or I wouldn't say arguably, it had a lot of factors. One of them being the pandemic itself, the response to the pandemic as well from the political side, how much the monetary pace and supply was expended at that period, the fiscal spending, the stimulus checks, and but also the whole thing had an impact on commodity prices. Hard assets has started to move in a way that we really didn't see a move like that in a very long time. And it is interesting that commodity prices are doing very similar move to that first wave of inflation that we saw back in 2021. Are we about to see a surge in prices? Oh, look, gold price is sort of a leading indicator. It tends to be a leading indicator for commodities. So if that's the case, if you look at a price of gold, of which I'll show it in a minute, it's going vertical. So, is it possible to see this chart going vertical as well? It wouldn't shock me at all. History is there for us to use it as a potential roadmap to understand what could likely happen here in the near future. So let's go to the next chart. This is also inflationary. Now let's talk about the stag side of the stagflation, of which we've had a few reports recently. I'm going to show two charts that I think are relevant. One of them is the one from today, which I think it's wow. I mean, it was down 0.9%. You annualize this number. We just had a 10% decline on retail sales. I mean, think about it. This is a pretty significant number. It's a very large drop in retail sales, the largest drop since March of 2023. At the same time as inflation is going the other way, and so this is quite significant because this also in nominal terms. If you look at it in real terms, the decline is even worse. So I'm not sure a lot of people are talking about this, but there's a clear divergence of economic activity actually waning while inflation has been on the rise. Now let's talk about another chart that I think it's part of this as well. On the next one. On the next one, now you're looking at what I think it's, and I'm sure Kevin would agree 100% with this, but you're looking at one of the biggest disconnects of fundamentals that we've probably seen in history, but also near term. When you look at what's been happening with, look, markets tend to move ahead of things, and what we tend to see usually is if markets are going up, it tends to have an impact on what estimates have been regarding earnings or earnings per share of most companies in the index. What is interesting, however, is that more recently, and you can zoom out on this chart, and you're going to see there's a very strong correlation between the white line and the red line throughout history. Now, recently, we're seeing a divergence between these two things. And so analysts and other folks are starting to change their estimates for earnings for most of these companies that are part of the NASDAQ 100, causing the estimates to actually fall quite significantly. It's now down about 10.4% as the prices of these shares of these companies are actually at all-time highs. And so keep in mind, the 10%, the 10.4% decline in estimates of earnings per share is not accounting the fact that we also, this is all nominal, right? So inflation, it should be playing a role here, and it's also inflating the red line, believe it or not. Although the red line is falling, it is inflating the red line, and so it has an impact of squeezing the margins of companies. So if you have stagflation, which is one of the worst combinations of an economic environment you can find, that is quite relevant what we're seeing here. Let's go to the next chart. I'm going to pick up here because I gotta go quick. Gold prices have been on a surge. Today we've seen a small decline, or not small. $60 is not a small decline, but no, nothing changes the thesis. I do think this is one of the most bullish environments I've seen in my career, at least for metals, and I'm talking about long term. And what makes me think about is the other derivatives of the gold trade or the gold idea that are yet to play out, in my view. Let's go to the next chart. So next chart, you're seeing the production margin of most of the mining companies. A lot of people have this view that mining companies never make any money. And so I wanted to put this chart together. The all-in sustaining costs for mining companies is at about $1,450. Right now, this is a median calculation of the top 50 miners by market cap across the Canadian and US exchanges. And in this model, I basically look at the median of the all sustaining costs, and now I'm looking at relative to gold prices. And you can see they're all on the same axis, just to show you the gap between the two. The gap means the margin of these companies. Now, keep in mind, all sustaining costs is more of an operating cost type of calculation. You don't have a lot of the things that usually you have in terms of CapEx to run a mine. That's another add to the calculation here, but not a part of the production margin that is supposedly what we're focused on here. And so it is remarkable to me that this is likely to create one of the best setups for the miners in terms of surprising on the upside when it comes to fundamentals that I've seen in my career as well. Let's go to the next chart. Gold miners cash flow per share has been on the rise. I showed this chart last week, and it's just another way of showing what I showed in the past chart, but now including mostly, it's just a cash flow. It's not including CapEx again, but you can see here that it is at its highest levels in 13 years, and I think there's ways to go here. We're just getting started on what miners can actually do in terms of profitability. And, that's why we're so bullish. I mean, this is yet to reflect on shares. And I think that some of the companies that have reported recently are just a first glimpse of that. And we're yet to see a lot more companies actually surprising on the upside, in my view. Let's go to the next chart. Next chart is the gold to oil ratio, which is a clear also picture of that. I was actually showing this chart. I'll give it credit to Kevin. I was showing this chart because I wanted to see how cheap oil is relative to gold. Number one. Number two is the second highest gold to oil ratio we've seen in history. When you exclude the craziness that we saw during the pandemic. But when I show this chart, Kevin was like, "Well, that's the margins of the miners." It's like, yes, that's it. I mean, that's a lot of the open pit projects that are heavily impacted by energy prices. That's your picture right here. Of most of these companies are enjoying the fact that oil prices are low relative to metal prices, and so their cost structure is been it's all-time highs. I'm not saying it's not. It is at all-time highs, but it's substantially lower than where gold prices are, and that's the part. It's that gap that I think it's so important, especially for companies. Let's go to the next chart. Finally, we're looking at the total assets under management. This has been a very different gold environment that we've seen in the past. The rush that we're seeing in terms of demand is coming not from Eastern societies only. It's certainly coming from there, from BRICS, from China, from Russia, but it's also coming from Western societies too. And the chart here, that's what it's showing. It's just looking at the AUM. A lot of people say, "Oh, look at the ounces and all that." I get that. I'm only focused on the capital coming into the vehicle. That's all. I'm not asking if there's gold in the vehicle or not. That's not the point of this. That's not the point at all. Everybody that made that comment, that's not the goal of this chart. The goal of this chart is showing how much capital is coming into this vehicle, how many investors are putting capital into something that is linked to gold prices. That's finally we're seeing the catch up of this ETF when it comes to attracting capital, and that's Western capital in my view. And this is why this time has been different. What we're seeing, I hate to use that word, but the expression, but we're seeing a much more combined demand coming from different parts of the world relative to what we saw in the past year. Let's go to the next chart. Almost done. If you think about gold, the derivative of gold, the high beta version of gold, that is emerging markets too. It's not only the miners, it's emerging markets. We're seeing a big surge in gold prices. If you look at historically, emerging markets, in my view, are about to show their strength as well. If we cap yields and we cap the dollar, the blue line tends to do very well. I think we're on the verge of seeing more of that, not less, more. And so I'm really focused on this as well. Let's go to the next one. And lastly, despite the fact that we had this a fading action in the markets today for silver, look, I've been following silver. This is my last chart. I've been following silver for a long time, and I'm just going to say one thing. If there are times when I've been following silver that I really think they're very meaningful. That you want to be, paying close attention to what's likely to happen here. And in my view, we're one of those moments. Gold prices have already gone up. Everybody is skeptical about silver, especially after today. And that's when the metal tends to like it. And I am extremely bullish. I think we can easily see a move to, retesting the levels of $40 an ounce there that we had there. I do think we're going to see a higher price levels. This is why I'm so bullish on on silver and think it's, in my view, the most undervalued metal on the planet. But I also think that that's the first step. It's retesting those highs, and I think we're about to see a big candle there. It's just my views, it certainly is. It's very timely what we're seeing in terms of action in silver prices, in my view. All right, I'm going to pass it on to Kevin Smith now. I do have to go, so Kevin, you take it from there.
All right, thank you, Tavi. Look, there was an article that the Wall Street, or not the Wall Street Journal, that Bloomberg ran yesterday about the, we've talked about this gold mark-to-market idea, or this gold revaluation idea that we believe is that Scott Bessent, our new Treasury Secretary, is behind, and we're close to some people that are advising him. And we think it's something that they are very much considering doing, the gold mark-to-market. And we've talked about it. We've written about it a little bit in letters to our investors. And it involves, currently the price of gold statutorily on the books of the U.S. Treasury is marked at $42.22 an ounce. And folks who are advising the Treasury Secretary, including Zoltan Pozsar, have been and Stephen Miran, who's the new chairman of the Council of Economic Advisors, have been entertaining this idea of the gold mark-to-market, which is a way of effectively monetizing the difference between the statutory rate of $42 an ounce and the current market price of gold, which is closer to $2,900 an ounce, and the net effect of that is potentially a $750 billion gain on the Treasury's balance sheet that can potentially be monetized based upon what Pozsar and we think Bessent and Miran are considering, and it's effectively a repo of this unrealized gain of the $750 billion gain, by the Fed, whereby the Fed would credit that amount of money to the Treasury general account, and the idea is that, well, that's $750 billion less of Treasury issuance that the U.S. government would have to do in the next year, by doing this. Now, this article that came out in Bloomberg was almost as if it was being planted by somebody to really try to knock down this idea. And there was about what could really be done here with the gold revaluation, and they even quoted the Stephen Miran paper, the same paper that I referred to last week and that we linked in our letter, suggesting that after this mark-to-market gain, that the Treasury could sell the gold, that it was a serious option to sell the gold. Well, if you read the Stephen Miran paper, it was a total straw man. The only reason he suggested that idea was to knock it down, because of course, we're not going to be selling the gold, or at least, that's a pretty far-fetched idea. And the Bloomberg article even talked about well, they could swap the gold for bonds, because bonds pay interest, for bonds in another country's treasuries or something like that. And this Bloomberg article right here, which is pretty funny because I think that's the exact opposite plan that we understand the administration is seriously considering right now. I mean, I don't want to get into this in too much depth, but Trump is out there negotiating right now with the world leaders and trading partners and adversaries and NATO allies, and we've got tariffs on the table, and the goal is to the goal ultimately, this is negotiations, and the goal, as Treasury Secretary Bessent has said, is to get the 10-year yield down and yields across the whole curve down. One of the key objectives here, but they have a bigger agenda that Trump's advisors are considering. So we think it was very disingenuous in this article where they say that sources, within Trump's administration are not even considering this mark-to-market gold idea or taking it seriously. We think that's quite the opposite, and encourage you to to read some read our last letters, read the Stephen Mirren paper more closely, and be more open-minded to what the administration is truly considering here. Let's go on to the just to point out real quickly, since there's a chart on this slide. The U.S. Treasury is the largest owner of any single entity on the planet of gold right now. 8.1 thousand tons of gold, and that's so this is important to understand. But it's important to understand that our European NATO allies collectively have a similar amount of gold in their reserves, and these are our NATO allies. And so there's a bigger plan here, because the gold to GDP of our NATO allies is even higher than the gold to GDP of U.S. So these swaps, and this idea of the U.S. Treasury, issuing longer term bonds, maybe even century bonds, 100-year bonds, and swapping gold with NATO allies, I think this is the bigger play at hand. So meanwhile, gold equities. This is a chart. I think Tavi may have shared this one on Twitter or in one of our calls, but I just want to point out that gold equities have rarely been this cheap. This is looking at price to NAV for companies that have a mine plan, that have reserves and have a mine plan in place. There's something called the NAV that is an engineering and economic report study, where you can look at the present value of a deposit, and you can compare them to the current market price of the stock. And the point of showing this chart is that along the same lines of Tavi's chart, showing that margins, because of the price of some of the key energy commodities that go into the biggest cost component of mining is the energy cost, and the gold oil ratio being at a record level is showing that mining companies have extraordinary margins and profitability right now, and at the same time they're trading at extraordinary discounts to their NAV. So this is just an incredible setup right now for mining companies that we believe are cheap, and it's also a setup for the what we call the M&A cycle. So let's go on to the next slide. And so we've done the study. I've showed this in the past. I just want to remind our viewers that on average, when a major mining company takes out an exploration company that has drilled out a gold resource, and the major mining company buys that whole company for that one discovery, on average, those firms get taken out for 17% of the resource value of the metal in the ground. That's at the median of all these examples over the last 15 or 20 years. And you can see in the green bars, in a bull market environment, the median acquisition price is 32% of the resource value of the metal in the ground. Neutral markets 17%, all markets 17%, bear markets 8%. We believe we are in a new bull market for precious metals and precious metals mining stocks. It has only just started. We've been through a 14-year bear market and consolidation for mining stocks since the peak of the mining industry back in 2011. And we think it's very early stages. And there are just a number of deeply undervalued mining companies out there. But the most deeply undervalued of them all, we believe, are in the exploration space. And that is, where the opportunity is as we get into an M&A cycle. And the M&A cycle is starting to pick up already. Let's go on to the next slide. So this is looking at our activist portfolio, which is the largest theme right now at Crescat across all of our funds. And this is looking at the activist portfolio outside of San Cristobal. San Cristobal is a private company that we invested in across our funds. It's been highly successful. It's one of the largest. It's like the number 4 largest producing silver mine in the world today. And they have a new discovery associated with it that is the Quentin has been super excited about. Our funds are the largest shareholder of San Cristobal, but we've had to put that into a side pocket because of the success that we have. But when you look outside of San Cristobal and the rest of our portfolio in the main fund, this activist portfolio is the largest theme across all of our funds: the precious metals fund, the global macro fund, the long short fund. It's the largest theme, and so this is just looking at the we have 69 different companies that we're invested in outside of San Cristobal. 37 of these companies have bona fide discoveries already: gold, silver, copper. These are discoveries where at least 25 of these, Quentin, our geologist, is extremely confident that these will become mines. They are so economic that they will become mines one day. And we're an activist strategy, so we own 9.7% of these companies. We have big activist stakes. At the median, we own 9.7% across the 69 stock portfolio. You can see in the maps that these deposits are located in friendly mining jurisdictions all around the world, and the map is showing both the relative size on the top map of the target gold equivalent ounces of our portfolio, and the bottom map is showing the number of drills. The size of the circles corresponds to the number of drills. Over the past 4 years, we have created this portfolio. We've been investing in this depressed industry that's been starved of capital, but we've been getting the money to these companies to do the drilling. We've had more greenfield drilling. Our companies have had more across our portfolio, have done more greenfield drilling than all the major gold mining companies combined. So we have this killer portfolio of new discoveries and incipient discoveries, whereby we have been able to create, outside of San Cristobal, we've been able to create 224 million target gold equivalent ounces of gold, silver, copper, zinc, nickel, manganese, and this is an enormous amount of gold in the ground. These are based on Quentin's geologic estimates, and our portfolio is still so deeply undervalued today relative to these estimates, and relative to that M&A takeout chart that we just showed. So are all of our companies going to get taken out by major mining companies? No, they're not, but we think some of them will. And there is a big divergence in the current valuation, which is, frankly, the valuation is trading less than 0.5% of Quentin's estimates for the resource value based upon the drilling to date. We are just really excited about this portfolio. Now, people will say, well, Crescat, you guys have been underperforming. Your precious metals fund has been underperforming gold and even the major mining companies in the past few years, and that's true. But I'm here to tell you that our performance is starting to pick up again, and we were up over 14% last month in the precious metals fund. Our global macro and net of fees, our global macro and our Long short funds were up over 15%, where we also have some short positions that we're adding value to above and beyond the activist metals portfolio. And Crescat is starting to perform again. Let's go on to the next slide, because this looks at the performance of the precious metals fund, net of fees, since inception 4.5 years ago. Now people will say, but Crescat, you've been underperforming recently, but you look at the total since inception performance of our funds versus all the various gold benchmarks, whether it's Philadelphia Gold and Silver Stock Exchange, that's the large cap gold and silver benchmark that have U.S. listed securities. You look at the Spider Gold shares, that's the ETF that just owns gold. Tavi was showing a chart on that, or the SLV, the Silver Trust that is just silver. The Van Eck Junior Gold Miners, a little bit of a misnomer. People think those are explorers, but they're really not. They're mid-cap producers for the most part in the GDXJ, the Junior Gold Mining Index, or the more senior ETF, the GDX, which is kind of like the Philadelphia Gold and Silver Index. This looks at the annualized performance since inception of all of these different benchmarks versus Crescat's fund. Our fund is up 19.3% net annualized. We've started to outperform the benchmarks again recently, like we did in January. And like this is the X side pocket performance, by the way. So this is what new investors coming into the fund are able to get, because new investors cannot participate in San Cristobal. You can read that disclosure down at the bottom to understand more about that, or go to those links on our website to see the total performance of the fund, including the side pocket, excluding the side pocket. I'm just here to tell folks that Crescat has been starting to outperform again, and when you look at our total performance since inception, we have outperformed the benchmarks substantially. I am really excited about the portfolio that we've built over the last 4 years. I think there's incredible opportunity still to put money to work in this space right now at this time, ahead of some really exciting macro tailwinds that we have, like we've been talking about with this potential gold mark to market. Let's go on to the next. So one thing that we noticed is that the year to date, and there's only year to date, there's only been a couple of weeks so far, but these over the weekends, the S&P performance has been slipping quite significantly. This is something that Bloomberg was highlighting today. Just thought we would show this, because, as you know, we still believe that we are in the midst of a rotation out of mega cap tech stocks and large cap growth stocks and into undervalued value stocks and commodity stocks, and precious metals. We are not giving up in our global macro and in our long short fund on the short theme that we have with respect to the mega cap tech stocks. Let's go on to the next. So B of A put out this chart looking at the total allocation among all mutual funds, all equity fund assets under management. And this is B of A Global Research. It's looking at active versus passive management. So one of the drivers really of this this large cap growth stock and mega cap tech outperformance over the past several years, we think has been driven by passive assets under management flows. And you can see that passive has overtaken active in terms of the distribution of managed money out there. So look, I went to the University of Chicago. University of Chicago is famous for one of the professors there, Eugene Fama, who's one of the who's kind of the founding father of the efficient market hypothesis, and which states that markets are efficient, and therefore essentially don't bother trying to do fundamental analysis and beat the stock market, because you can't. And of course, this idea challenge me because I just frankly didn't believe it, didn't buy into it. I mean, that's why I'm an active manager. That's why I got into this business. That's why I've sought to prove, over all the years that I've been in the business, that we can outperform the S&P 500. But look, passive has had an incredible run, and but this is part of the imbalance today. And what is this imbalance? Let's go on to the next chart. It's called the Grossman-Stiglitz paradox. And these guys, Stanford Grossman and Joseph Stiglitz, this is one of the papers that I studied when I was in business school in 1992. They came up with this, with their theory that that argues that perfectly informationally efficient markets are an impossibility, because if prices perfectly reflected all available information, which is Fama's efficient market hypothesis, there is no profit to gathering information, in which case there would be little reason to trade and markets would eventually collapse. Well, this is kind of the idea and the tension when too many people are on one side of the boat, passive, who's doing the fundamental analysis? And that's why you can have these divergences like Tavi was showing, where the earnings estimates for the NASDAQ 100 are coming down at the same time as the stock prices are still going up. It's because the flows just keep coming into passive investment, every biweekly paycheck. And because these indices are market cap weighted, more money keeps going into the biggest stocks. And it's like, who's running who's actually doing the security analysis out there today. So, I'm not giving up on doing the security analysis, on trying to outperform the market. Our strategies have outperformed the markets over long time frames. We've had some underperformance recently, no doubt. But that's because we're different. We're not just chasing the passive indices. We're long, we're short, we're value investors. We have counter-cyclical ideas. We're contrarian. And over time, we believe that's something that pays off. Let's go on to the next. Here, Nathaniel thought this was an interesting chart. He's one of our analysts, so I just wanted to show that after that retail sales number today, which Tavi was talking about, kind of showing some stagflation, that the expected, there's a whole nother rate cut priced into the market now, expected for this year in 2025. So that, that's how important, this fundamental macro data is to the markets and the interest rate markets, and this idea of stagflation. Stock market, not paying attention to this kind of stuff, because here we are retesting the highs of the S&P 500 and the NASDAQ 100 today. It's pretty crazy. But remember that weekend phenomenon that's been happening. Things, we'll see what happens on Monday. Anyway, let's go on to the next, my last chart here. This is, to get back to this idea of the Grossman-Stiglitz paradox, and why it may not be the smartest thing to just be, long and passive, because that's what's worked. Grossman and Stiglitz said no. Eventually, that doesn't work. If nobody was minding the farm and everyone was just passive, the whole market would collapse. Well, this is showing the Global Macro Fund, the Crescat Global Macro Fund, which has a 19-year track record now, and it's showing one thing that's different about what we do here. We're not just a long-only global macro fund. We're contrarian. We're value investors. We're macro investors. We have short positions. We take contrarian stances and long positions in things like gold. Our fund has had what is called a negative downside capture ratio versus both the S&P 500 and versus the the HFRX Global Hedge Fund Index since inception 19 years ago. What does this mean? What's a negative downside capture ratio mean? It means that on average, when markets go down on down months over this 19-year history of down months in our global macro hedge fund, our fund has actually gone up during those down months. Well, that's kind of unique. That's kind of different. And past performance is no guarantee of future returns, but this is a reflection of our mindset and how we think and how we position the portfolio. We're not afraid to be contrarians. We're not afraid to have short positions. We're not afraid to own value investments even when growth in large cap and mega cap tech has been in favor. And how has that played out historically? Well, in down, and there have been a lot of down months over the last 20 years. We've been through the global financial crisis. We've been through other choppy market periods, whether it was the COVID 2020 recession and blip recession in 2020, and on average, or whether it was a 2014 2015 year period that was a pretty choppy period. Other events like Volmageddon. On average, our fund has gone up in a down market. So I'm just pointing this to people's attention that this is something different. Maybe it's time for people to be considering something different in their portfolio allocations, and something different than just getting long the Magnificent Seven, just getting long passive investing. Valuations are expensive. We've shown a number of times in the past. I'm not going to dwell on it here. The valuations of the S&P 500 and the NASDAQ 100 and the Mag 7 are historically stretched. The market concentration, this is a risk. Maybe it's time to look at something different in your portfolio allocation. And that's what we offer here at Crescat. So that's all I have for today. We'll be back next week with Quentin to get more in depth into our mining portfolio and for him to catch us up on all the news. There's been a lot of exciting news even in the past week, and I think there's going to be a lot more over the next week among our mining portfolio. So we encourage you to tune in next week. Follow us on X or Twitter, and follow us on YouTube. And if you're interested in learning more about our strategies, don't be shy. Reach out to Merrick. His contact information is here. Give him a call, shoot him an email, and we would be happy to set up a call and have a conversation with you. So that's all I have for today. Thanks, everyone, for tuning in, and we'll be back next week.